The trade war took a dangerous turn and is now morphing into what many are calling a currency war. It's all-out economic warfare between the two biggest economies in the world, US and China.
Currency wars have been around for centuries. Nations have historically competed against each other for economic and geopolitical power. The best way to measure this power is with currency. Currency can be thought of as the common stock of a nation. In recent years, a new player has emerged in the currency arena: crypto. Crypto isn't controlled by a single nation or central banking cartel. Instead, crypto can be thought of as the people's currency. The philosophy behind crypto is simple. Crypto offers a stable monetary base, accountability for its transactions, and a blockchain framework that protects itself from manipulation. The recent price appreciation of two of the biggest cryptocurrencies is staggering. In the last 2 years, Bitcoin is up 350%, while Ethereum is up a mind-boggling 1,600%. This begs an important question to ask. Is crypto currently in a bubble of historic proportions, or is crypto actually a long-term solution to our current out-of-control monetary fiasco? What's driving the price of crypto to the moon? Distrust in the current financial system is leading the charge. The fiscal mismanagement by central banks has created trillions of dollars out of thin air, leading to fears of hyperinflation, which we have recently seen in countries like Venezuela, Zimbabwe, and Argentina. Out-of-control spending by politicians has investors searching for a safer store of value. But these fundamentals aren't the only driving force. Speculation is a huge factor. Stimulus checks, PPP loans, and other so-called COVID relief money has found its way into the crypto market, adding fuel to the speculative fire. FOMO, the acronym meaning the fear of missing out, has propelled crypto prices to unimaginable levels as investors pile into these digital currencies. This irrational exuberance has crypto walking a fine line between bubble and a technology that could potentially revolutionize the future of currency. What can history tell us about past bubbles? Let's start with two bubbles from several hundred years ago. First, the Dutch Tulip Mania of the 1600s was one of the earliest examples of excessive greed and speculation. Tulips were introduced to Europe during the 16th century. The exotic flowers looked like no other flower known up to that point. Tulips quickly became a symbol of status and wealth. Demand for tulips skyrocketed. People began to purchase tulips exuberantly, and speculation went wild. Rare tulips traded for as much as 6 times the average annual salary of a Dutch working citizen. In 4 months' time, the price of tulips skyrocketed 20-fold before subsequently crashing by 99%. This speculation and short-term price movements is very similar to what we are currently seeing in the crypto market. Next comes the South Sea Bubble of 1720. This one is a bit more complicated, but it shows what can happen when government finances mix with a newly emerging stock exchange in London. In 1720, in return for a loan of $7 million to finance the war against France, the House of Lords passed the South Sea Bill, which allowed the South Sea Company a monopoly in trade in South America. Shares of the South Sea Company instantly soared tenfold as citizens poured their life savings into shares of the company. Almost just as quickly as the shares rose in price, shares crashed, causing severe economic hardship for many. This crash happened in the early days of the British stock market. Being that crypto is still in its early stages, similarities exist. Let's now jump forward to the 1980s and look at the Japanese asset bubble. In the 1980s, the Japanese government embarked on a monetary policy that focused on devaluing the yen to make exports cheaper with the hopes of economic growth. The Bank of Japan slashed interest rates and made credit readily available. This led to uncontrolled money supply growth, which was fueled by excessive credit expansion. The Japanese real estate market and stock market skyrocketed from these newly printed yen. The Nikkei 225 stock index skyrocketed and peaked at over 38,000 in 1989. This led to a 2-decade-long recession in which stock prices declined to well below 10,000 in the early 2000s. To this day, the Nikkei still hasn't surpassed its 1989 peak. The recent quantitative easing and stimulus by the US government draws deja vu-like similarities to what Japan faced back then. The dot-com bubble is another example of a tech-fueled speculative boom in stock prices. From 1995 to 2000, the Nasdaq stock index rose by over 500%, only to subsequently fall by almost 80%, bottoming in 2002. The fundamentals behind the dot-com bubble were solid, but speculation fast-tracked this irrational exuberance into bubble territory very fast. No one can deny that the dot-com boom has changed the world with its technological advances over the last 2 decades. It's just that investors piled in too hard, too fast at the get-go. Many say that blockchain and the crypto boom is today's dot-com bubble. Have investors piled into crypto too hard and too fast, just as we saw with the dot-com boom? An even more recent example of a massive bubble is the housing crash of 2008. New lending by government institutions like Freddie Mac and Fannie Mae started with good intentions. These institutions were created to help make housing more affordable to lower-income people, but quickly morphed into vehicles that fueled a massive speculative boom, exacerbated by low adjustable interest rates, no down payments, and fraudulent underwriting. Mortgage brokers, investment bankers, and real estate speculators all joined the party. Mortgage brokers were issuing no-look subprime loans, meaning that zero due diligence was being done in the underwriting process. A majority of the borrowers had no income and no means to repay these loans. Low adjustable interest rate loans were being issued like beer at a tap house. Mortgage brokers had turned a blind eye to underwriting standards. Investment bankers then packaged these subprime junk mortgages into AAA-rated investment vehicles and sold them to banks, mutual funds, pension funds, and other investors who thought they were getting a risk-free AAA-rated bond at an attractive yield. It was a game of pass the buck. The housing bubble had corruption on every level. Ultimately, interest rates began to rise, causing adjustable rate mortgages to reset. Mass foreclosures ensued. This caused a cascade effect throughout the entire financial system. When the music stopped with this game of hot potato, investment banks Bear Stearns and Lehman Brothers were caught holding the bag on billions of this worthless mortgage debt, forcing them into insolvency. The entire banking industry took a massive beating. Both the housing market and stock market plummeted as fears of systemic failure in the entire financial system took hold. What started as a ripple effect now turned into a tsunami as credit was frozen across the entire economy. It wasn't just mortgage borrowers who saw credit dry up. Corporations saw short-term credit sources, such as commercial paper, disappear. The housing bubble really exposed the financial and economic systems as a giant set of dominoes. The housing bubble became a catalyst for the emergence of crypto as investors now recognized the need for a more fair, stable, and balanced monetary system. As investors, we need to ask ourselves some important questions. Will crypto fix our broken, corrupt, manipulated financial systems? Will crypto restore accountability? Will crypto fix the wealth gap and restore the fundamental value of meritocracy to an economy plagued by hedge funds, Wall Street bankers, and other financial vultures? Or is crypto just another historic asset bubble? As I mentioned earlier, currency can be thought of as the common stock of a nation. For the last century, the US dollar has been the unofficial reserve currency of the world. Up until the 1970s, the dollar was backed by gold. The backing of gold had both advantages and disadvantages, which we won't dive into today. After the gold standard was abandoned, the US dollar had to rely on other factors for its strength. Factors such as strong economic growth, favorable taxes, global trade, innovation, and prosperity all contributed to the dollar's success as a reserve currency. But one factor stood out as the elephant in the room, and that factor is the US military. The military might of the US government is thought to be the critical factor supporting the dollar's reserve status in the world. Will crypto emerge as the reserve currency of the world? For crypto to become a reserve currency, several factors must be addressed. First, crypto will actually have to transition from being just a digital asset into a currency that is actually used to trade goods and services. Processing times in the blockchain verification process will have to be dramatically reduced to compete with the near instant processing times of credit card transactions today. Furthermore, lending and borrowing of digital coins will have to adapt within the blockchain framework. Digital wallets and other technologies must continue to evolve. Look for companies like PayPal with Venmo, Square, Coinbase, and other fintech companies to address these issues in the near future. Crypto, the quote-unquote people's currency, is emerging as a one-world type of currency, not bound by nationalistic borders or restrictive trade policies. No doubt, current government elites will see this as a threat. Will these government elites attempt to tax, regulate, and even outright ban cryptocurrencies?
Governments, the first thing they do is form a currency. They like to control the currency. They control it through a central bank. They also like to know who has it, where it is, where it's going. Okay, and you just saw China just is closing down the Bitcoin exchanges.
China has banned financial institutions and payment companies from providing services related to cryptocurrency transactions. Other nations like Turkey, India, Nigeria, Bolivia, Ecuador, Algeria, Nepal, South Korea, Qatar, Egypt, and Bangladesh have banned or threatened to ban crypto payments. Even the United States has introduced regulations on crypto with the proposed infrastructure bill. Will these regulations hinder or accelerate the adoption of cryptocurrencies? Let me know what you think in the comments. An absolutely critical feature of any currency is price stability. Every day, goods and services are bought and sold by millions of people across the world. Price stability is critical for world commerce to take place. It's fair to say that currently, crypto isn't stable by any means. Let's look at the following spreadsheet showing the daily price changes in Bitcoin. Cells highlighted in red show a 5% or greater decline in a single day. Bitcoin frequently sees daily price declines of 10% or more. On the flip side, the US dollar rarely fluctuates over 1% on a daily basis. Over the past 5 years, the dollar index has only dropped 1% or more in a day a handful of times. Price stability is critical for any type of currency to be used in trade on a daily basis. Bitcoin has a long way to come in that regard, and the US dollar currently holds a huge advantage. If cryptocurrencies want to overtake traditional currencies, their price fluctuations must stabilize. As we said earlier, the housing bubble laid the foundation for the adoption of cryptocurrencies across the world. The 2008 financial crisis exposed the financial system as sitting on a house of cards in which one area of weakness could morph into a domino effect of systemic failure. The good old boy Wall Street network has been around for decades. This investment banking cabal has been involved in countless reckless behaviors, such as the long-term capital management crisis in 1998, to the financial crisis of 2008, to the recent controversy surrounding hedge funds and GameStop. But is crypto any different? Blockchain is a new decentralized system created and led by a new cabal of developers and early investors. As problems arise within the framework, developers must deal with so-called forks in the system to resolve any issues with blockchain verification or cyber attacks. This new crypto cabal also consists of some very big holders who can use their market clout to manipulate prices against smaller investors. And did I mention that these investors happen to be totally anonymous? Their actions can significantly affect the daily price fluctuations in the underlying cryptos. In essence, the crypto system echoes the current system led by Wall Street, only the players are changing. Buying and selling by big investors isn't all that dissimilar to the shenanigans played by hedge funds. The only difference is that big crypto holders don't have access to a printing press to print unlimited sums of new money.
Simply flooded the system with money.
Yes, we did.
With our current centralized financial system, the big players and their moves, excluding dark pools, are generally known. To play devil's advocate, it's actually a fairly transparent system. The SEC can track holders of most stocks via regulatory filings. The Treasury Department can track foreign and domestic holders of U.S. debt. We have access to thousands of financial statistics at our fingertips. This transparency is often overshadowed by greed and excessive money printing, which makes the playing field stacked against the small retail investor. The main philosophical issue is that greed and corruption can ultimately undermine any financial system, whether it be centralized or decentralized. Is decentralized finance and crypto really the solution? Please leave your thoughts in the comments. Blockchain technology has significant advantages in terms of accountability. Every transaction must be verified by thousands, if not millions of computers across the world. On the other hand, the current financial system has, well, close to zero accountability. Central bankers have the printing presses running on overdrive, hedge funds openly try to destroy companies via devious shorting tactics, and politicians have little regard for fiscal accountability or the national debt. Another important question that needs to be asked is, who created Bitcoin? Rumor has it that Satoshi Nakamoto was the original developer of Bitcoin, working alongside others. However, the true identity of Nakamoto remains unknown. How much Bitcoin does Nakamoto own? Can Nakamoto's crypto clout be used to manipulate the price to his or her advantage? Can blockchain and crypto really solve the wealth gap, not only in the United States, but the world at large? Our system's current way of addressing the wealth gap is through stimulus checks, unemployment benefits, welfare payments, food stamps, foreign aid, and tax credits. Most of these measures are paid for through fiscal deficits and financed by printing money out of thin air. Let's assume that crypto replaces traditional currencies at some point in the future. Bitcoin and other cryptos have a finite supply. This gives a massive wealth discrepancy advantage to current holders. What should society do with the millions, if not billions of people who don't currently own any crypto? Will blockchain developers have to introduce some sort of universal basic income into the framework to address this wealth gap issue in the future? Furthermore, what happens if another black swan crisis rocks the financial world? Will crypto developers have the ability to adapt and alter the current finite supply of digital coins and provide stimulus if necessary? The socio-economic world isn't black and white. These gray area questions are just a few examples of fair and important questions that need to be addressed. Theoretically, blockchain is a great concept. It has the potential to restore accountability and remove manipulation from the markets. But has crypto's recent to-the-moon price action actually created a major roadblock to its implementation? Is crypto just another massive bubble? The world isn't fair and it likely won't ever be. As investors, we must pick and choose where to allocate our assets with the hope of finding the ultimate store of value. If you found this video helpful, please hit the like button and subscribe so that we can evolve and provide more useful content in the future.